Hello, welcome to another lesson with Trading with Rich. My name is Rich Dickey, and I'm here to give you a quick lesson on how a put expires. This is going to be a fairly short lesson. I'm going to try to keep it to one example, and I'm going to try to make it short and as simple as I possibly can. So here we are looking at Alibaba. Alibaba is currently at 213. So we're going to take a look here at Alibaba. And it's July 15th at 12:22. Our position, our obligation on this put contract expires tomorrow at 3 o'clock. So we have one more day to go, July 16th. We have put an obligation out there to buy 10 contracts of Alibaba at 210. Now 10 contracts is 10 times 100 stocks. This lesson is going to show you how to exit this particular contract. So I have insured 500 of those shares at 207. So I'm going to, if it goes below 210, I can't lose any more money than at 207.5. So my risk is between 210 and 205. Look at it again. Okay. I have made a contract to purchase 10 times 100, which will be 1,000 shares of Alibaba if it drops below 210. It's currently at 213.66. I insured that and limited my risk so I can't lose any more money going below 207.5. So my risk is between 210 and 205. And then I bought another 500 shares, 5 contracts, and put my risk factor between 210 and 205. So if it goes any lower than 205, I'm obligated to buy it at 205, but not at 204 or 203. I've got 500 shares. I'm obligated to buy it at 207, but not at 206 or 205. So right now, this contract has been out there for 2 weeks. And when I originally bought it, I got a $4,790 credit. And then I went and bought the insurance to limit my risk. I gave them back $1,835. And then I limited my risk on that one. I gave them back $1,700. So when you add those two together, you get $3,555. So $3,500 minus 47 make about $1,200. So this thing's been bouncing up and down for the last month. It had been about a month and a half ago at about $255. So, am I real confident that it won't go below 210 tomorrow? Not really. Not really. It's saying that there's a 97% chance that it will stay above 210, and I kind of like that. It's saying there's a 1% chance that I'll go below 207 or even 205. So the odds are in my favor. But what a lot of brokerage firms will tell you is take your profit at 50%. Well, I've got about $1,200 worth of profit that I started with. And if I pay back $460 and then they give me $267, I should only have to pay back, about $200. Just rough guessing. So this is how you close out a put. And I'm going to close it out instead of waiting until tomorrow. At least that's what I plan on doing. Let's go ahead and close these two positions. Notice one had 10 and one had 5. I'm going to have to adjust this down to where they both say 5. So what I'm looking at is telling me that you're going to buy back those calls, buy back the put at between 45 and 48 cents. Remember, everything is always a bid and an ask. This is what they're asking. This is what I'm bidding. You end up somewhere in between. So first thing I'm going to do, I'm going to highlight that, and I'm going to make go 10, 9, 8, 7, 6, 5. And here's what the suggestion is. 15, pay 15 cents back. Now, the contract ends tomorrow, so I've got to do this by tomorrow. I could set this for today, or I could set it for tomorrow. I may even drop this a few cents, and then you know, see what it looks like getting closer to 3 o'clock. But I'll try 12. Yeah, it's at 17 for mid. I'll leave it at 15. So what it says it's going to do is I'm going to pay $75 in the debit, and it'll increase my buying power by $1,100. If this order is filled, you'll realize a profit of 85. If I want to adjust the order before I move on, I can always go over here and adjust it. I think I'll go ahead and do that. I'll put it at 13. And now my profit just went up to $4.95. So I'll go ahead and send this. There it is, 5 and 5. So I want to buy back what I sold before. I sold a 210, so I'm going to buy it back. And then I bought a 207.5 insurance, so I'm going to sell that. So I'm going to buy back my obligation and sell my put that I purchased earlier. If I want to edit it, say I want to change that 13 cents to 14 cents, I can go over here and, you know, click on anything, click and edit, hit review. It'll tell me I'm going to make $490. Hit send, and now it's updated. And it's 14 cents now instead of 13 cents. That's how you put the order out there. Off. I'm going to close this position, do the same thing I did before. Go into the 10 and take it down to 5 so that they match up 5 to 5. Now this is a different contract. The purchase of this 205 was a little bit more than the the purchase of this 205 is a little more than what the purchase was of the 207. So actually I have less money to have to buy back. And they're saying a 410, 210 is actually midpoint's going to be about 22. So we'll put about, you know, let's put about an 18 in there. And we'll make it for tomorrow. So it will end. This is good till. This order is time in force. Good till 7/16. I'm willing to pay a debit, which I'm going to pay them back some money out of what they've already given me. And I'm going to leave it at 18 cents. It says I'll increase my buying power by $2,400. So I'm I have this money allocated to give to them in case I did go below 210. They're going to give that all back to me. The brokerage has held $2,500 and $2,408. They've held that. Now I'm going to pay $90 back, and my profit will be $585. So a profit of $585 on a $2,400 investment. Now that's about, you know, 6 into 24 is 1/4. So that's 25%. 1/4 is 25%. 25% over 2 weeks. Not a bad haul. It gets done. So this one I paid a little bit more than this one. So let's go ahead and adjust this one first. So I'm going to hit the edit order. I'm going to try to go to 16. I'm going to go ahead and pop in a revised order. It went from 14 to 16. I raised it 2 cents. Now I'm going to pay them back $80 and keep the $480. So once I put that in there, probably won't take because normally it has to be over the price. But now I'm pretty close to what the midpoint was. Now, if I let this go ahead and go, the longer that this order stays out there, the longer the time value is going to go down. Well, what do I mean by time value? Well, actually, take a look at this put. And you'll see that at 210, they're actually saying that if I wanted to get out of this contract, I'd need to pay $485. And I really don't want to, you know, pay $485, but I did make $4,800. So I'm only going to pay back 10%. So I'm going to make 90% on this deal. So I think what I'm going to do, because I do feel pretty confident that it'll stay over 210 until noon tomorrow at least. I could watch it go into tomorrow, but look at this. The midpoint is bouncing up on that one from 22 to 24. This one's 16 to 17. I think this one will probably go within the next couple of hours. I did promise you that I would go ahead and let this go, so I'll show you how you get it. get it up there to let it go and put it up to 17. This is how you go back and forth. You're bidding. I just offered you $5 more. Will you take it now? Because there's 5 contracts and I bumped it up a penny, and a penny times 100, I just offered you $5 more. Would you go ahead and take it? Probably not. And in my experience, it usually have to be a penny over the midpoint, maybe even 2 pennies. So we'll go a penny over the midpoint. So they're out there, the brokers are talking to one another, and they're talking to the person on the other end, and they're trying to see if somebody will take this obligation off my hand. Doesn't even have to necessarily be the same person that bought it from me. It could be somebody else wanting to, take the 18 cents off my hand. And I'm going to put it at 18. I'm really not feeling good about it going up much higher than that. But since I promised you, I will do it. Pay another $5, and this one will go. It's been my experience. You usually go up 2 cents over, it'll go. It's gone. So now, all I have left is this one, the 205 to 210. If I changed it to the 18 cents, one last gyration here, we'll put it at the 24. This is how much they want right now. They want 24 as a midpoint. They're actually asking for 26. So if I gave them their 26, I'd only make $490 and I'd pay them $130. So what I'm trying to do is collect this 130 and turn this into 620 in one day. And that is what I'm going to do. So let's clear all orders, take ourselves out of it. We're going to have these 5 out there. Whoops, I didn't mean to put that at 18. Did I put that at 18? Sure didn't mean to. I'm going to put that at 5. Try to make $5.95 at this point. Remember, it was at 6 before and it was showing $5.90. And I'm going to send the changes. So if you're quick, even if I put it out there at 18, if it would have taken at 18, I guess I would have lived with it. But I'm actually putting a bid out there at 5. The midpoint is 24. They're asking 26. If they wait till 3 o'clock tomorrow, that thing's going to be 0. So I have it good through tomorrow. That is how you work a put. And this was a quick lesson. I hope that wasn't too confusing, but what we did was we had a 16th. We had an obligation out there for 10 contracts. We bought ourselves out of that. We paid back a little bit of money. We ended up making $485 on that deal. On this next deal, we're going to try to make $620. And if you went ahead and put down how much I actually paid for that, and then my insurance, voila, look, that's $620 difference. Isn't that funny how that worked out? Right now, I can get out of it for $240 minus the $122. I can get out of it for $118. But I'm going to try to keep that $118 and keep it all for tomorrow. At the worst, they may take my order that I put down here at 5 cents times 5, which is 25, and I'll pay back $25, and we'll be out of it before 3 o'clock tomorrow. So thank you for checking in with this lesson. This lesson was about how to exit a put that you have in the system, and we sold some and we kept some by putting an order out there. And if it leaves before 3 o'clock tomorrow, fine. If it doesn't ever go down to a nickel, I'll just let it expire at 3 o'clock and hope that it doesn't go below 210. Thank you for studying with Trading with Rich.